Welcome to FOREX School. This is Support and Resistance Mastery, the complete lesson. If you only ever learn one technical skill as a trader, make it this one. Every chart you will ever open, on every pair and every time frame, is shaped by the levels we're about to study. Here's the roadmap. We'll define support, then resistance. We'll dig into why these levels actually work, the real order flow behind them. We'll cover which timeframes your levels should come from, because that single choice separates clean charts from cluttered ones. Then the practical core, how to draw levels properly, how to read a bounce versus a break, and finally the mistakes that cost new traders the most money. Everything is taught on real chart structure, so you can apply it the moment we finish. Let's start at the foundation. Support. Support is a price area where falling markets repeatedly stop falling. Watch this. Price is moving down, down, and then, at this level, buyers step in. The fall stops. Price turns. Now watch what happens when the market comes back down to the same area. Again, buyers appear, and again the level holds. This floor in the market is support. The more times price touches it and turns away, the more traders are watching it, and the more significant it becomes. 3 things make a support level meaningful. First, the number of touches. 1 bounce is chance, 3 is a pattern. Second, the reaction size. Strong, fast bounces mean strong buying interest. Third, recency. A level respected this week matters more than one from 2 years ago. Keep these 3 tests in mind every time you mark a level. Now flip the picture upside down. Resistance. Resistance is the mirror image of support, a price area where rising markets repeatedly stop rising. Watch price push up into this level and stall. Sellers are waiting here. Price gets pushed back down. It rallies again, same level, same rejection. That ceiling is resistance. Nothing mystical is happening, there is simply more selling interest than buying interest at that price, every time the market arrives. And here is the single most useful property of these levels, they swap roles. When price finally breaks through resistance and holds above it, that old ceiling very often becomes the new floor. Traders call this a flip, or role reversal. Old resistance becomes new support, and old support, once broken, becomes new resistance. This one idea powers half the professional playbook, and we'll use it later in the lesson. So why does a line on a chart stop a global currency market? Because it isn't the line doing the work, it's the orders behind it. 3 groups of traders create these levels. First, traders who missed the last bounce and are waiting to buy the same price again. Second, traders trapped in losing positions who will exit at break-even if price returns to their entry. Third, the biggest group, large institutions who can't buy everything at once, so they leave resting orders stacked at the prices they care about. When price arrives, those orders execute, and the market reacts. This is the mindset shift. Support and resistance are not lines. They are areas where real orders live. Once you see levels as order zones rather than pencil lines, everything else in this lesson clicks into place. And here is what that order flow means for you in practice. First, you expect reactions, not reversals. A level's job is to produce a response. Whether that response becomes a full reversal depends on everything else in the market. Second, expect imperfection. Orders are stacked across an area, so price will overshoot and undershoot by a few pips. That is normal, not failure. Third, expect decay. Every touch consumes some of the resting orders, which is why a level that has held 5 times is often weaker on the 6th than it was on the 3rd. Levels are not walls. They are supplies of orders, and supplies run out. Now, which chart should your levels come from? Here is the hierarchy. Weekly and daily levels are the strongest on the board. Banks, funds, and algorithms all see them, and they can hold for months. 4-hour levels matter for the week ahead and are the workhorse of most swing traders. Anything below 1 hour is noise for level drawing purposes. Those minor levels break constantly, and they will fill your chart with lines that teach you nothing. The professional pattern is simple: identify on the high time frame, execute on the lower one. Your levels come from the daily chart, your timing comes from the smaller one. Burn this into your process: identify on the high time frame, execute on the low one. Time to get practical. Here is the professional process for marking levels, in 4 steps. Step 1. Zoom out. Start on the daily chart. The levels everyone can see are the levels that matter. Step 2. Mark the obvious turning points, the major swing highs and swing lows where price clearly reversed. Step 3. Draw zones, not lines. Give every level some thickness, because markets turn in areas, not at exact pips. And step 4. Less is more. If you have 15 lines on your chart, you have none. Keep the 3 or 4 levels that price has respected most recently and most violently. Let's apply that on a chart. Here's the zone drawn properly. See how it has depth. Price doesn't respect one exact number. The wicks pierce slightly different prices each visit, but every turn happens inside the zone. If you had drawn a razor-thin line at the first low, the second and third touches would have looked like misses, and you'd have doubted a perfectly good level. The zone captures all 3. That thickness is not imprecision. It is realism. And the same discipline applies to a ceiling. Here's a resistance zone drawn with proper thickness. 3 separate rallies into the area, 3 rejections, and notice again how each rejection wick reaches a slightly different high. A thin line at the first high would have called the later touches misses. The zone reads them correctly: same sellers, same area, same message. Draw the zone, respect the area, and let the wicks do what wicks do. Now the question every trader asks: when price comes back to a level, will it bounce, or will it break? Nobody knows in advance. Anyone who says otherwise is selling something. But the market leaves clues in how price approaches the level. A slow, grinding approach with small candles after a long move often bounces, momentum is exhausted. A fast, aggressive approach with large candles, especially on the first touch of a fresh level, breaks more often, momentum is in charge. And watch the reaction candles at the level itself. Long rejection wicks say defenders are present, repeated tight closes pressing against the level say the defense is failing. Here's a break and retest playing out. Price presses into the ceiling once, twice, then look at the third approach: bigger candles, barely any pullback, and the level snaps. But the lesson isn't the break. It's what happens next. Price comes back down to the broken ceiling and bounces off it. That is the role reversal from Chapter 3, live on the chart. Old resistance, new support. The retest of a broken level is one of the most studied moments in all of technical trading, because everyone from retail to institutions is watching the same spot. Before we wrap up, the 4 mistakes that cost new traders the most. Mistake 1: drawing too many levels. Clutter creates hesitation, and hesitation creates bad entries. Mistake 2: treating levels as exact prices and abandoning them the moment a wick pierces through. Mistake 3: trading a level blind without reading the approach, as if every touch were equal. And mistake 4, the expensive one: assuming a level will hold because you want it to. The level doesn't know you have a position. Read what price is doing, not what your account needs it to do. Let's lock in what you now know. Support is a floor created by buying interest, resistance is a ceiling created by selling interest. These levels exist because real orders rest there. Strong levels show multiple touches, sharp reactions, and recent respect. Draw them as zones on the higher timeframes, keep your chart clean, and read the approach before you judge the touch. And remember the role reversal: broken levels flip sides. Master this, and every strategy you learn from here builds on solid ground. That's support and resistance mastery. In the next lesson we build directly on today's foundation, trend structure, and how levels behave inside a trending market. Subscribe so you don't miss it, and find the full Forex School course playlist linked below. This lesson is education, not financial advice. Trading involves risk, and and past performance never guarantees future results. See you in the next one.